webinar hosted by the London School of Emerging Technology. Thank you all for taking the time to join us today, whether you're joining us from the UK, Europe, Asia, Africa, or anywhere else in the world. We're delighted to have you with us. My name is Kelly, and I'll be your host for today's session. At LSET, we are committed to bringing founders, entrepreneurs, innovators, investors, and business professionals together through practical learning experiences that help transform ideas into successful businesses. Through our webinar series, industry workshops, startup incubator, and innovation programs, we aim to bridge the gap between knowledge and real-world business success. Today's masterclass is particularly relevant because fundraising is becoming increasingly competitive. Investors are no longer investing based solely on exciting ideas. They're investing in businesses that demonstrate clarity, execution, scalability, and long-term value. Many founders spend months building an incredible product, but only a few days preparing the presentation that could determine whether they receive funding. That presentation is often the difference between securing investment and receiving another rejection email. Today's session is designed to help you understand exactly how investors think, how they evaluate businesses, and how you can position your startup more effectively when seeking investment. Throughout today's webinar, we encourage everyone to stay engaged. If you're joining us live on YouTube or from you, are you building a startup, planning to launch one, or simply interested in fundraising and investment? We'll also be taking questions throughout the session, so feel free to add them in the chat as we go along. Now, it gives me great pleasure to introduce today's speaker. Daniel Helman is an experienced entrepreneur, startup operator, and advisor with more than 2 decades of hands-on experience helping businesses grow, scale, and succeed. Throughout his career, Daniel has worked with founders, executive leadership teams, investors, and high-growth businesses across technology-driven industries. He has advised startups at various stages, from idea validation and market entry to fundraising, operational scaling, customer acquisition, and long-term strategic growth. His expertise covers startup strategy, business model development, investor readiness, go-to-market execution, leadership development, and sustainable value creation. What makes Daniel's perspective particularly valuable is that he doesn't simply advise founders. He has lived the entrepreneurial journey himself. He understands the challenges of building a business, making difficult strategic decisions, raising investment, managing uncertainty, and creating companies that investors genuinely want to support. Today, Daniel will share practical insights into investor psychology, startup valuation, and what sets fundraising from unsuccessful ones. Daniel, thank you very much for joining us today. Over to you.
Thank you, Kelly. Great to be here. Always a pleasure to speak with our audience of entrepreneurs, because every successful company started with someone trying to solve a problem. And some of you are already running these businesses or starting these businesses, refining your ideas. Others are maybe preparing to raise investment. And regardless of where you are on that journey, today's session will hopefully help you think differently, not just as a founder, but as an investor. And it's about understanding what investors look for when they're evaluating your business. And by the end of today's webinar, hopefully you'll walk away with a slightly different perspective on valuation, fundraising, the pitch deck within that process. So let's begin. When founders are starting the fundraising process, they focus on questions like how much should I raise, what valuation should I ask for, etc., etc. Whilst those questions matter a lot, the first question must always be, why should I believe this business will succeed? Would I invest and take a punt on this business? Everything else comes afterwards, whether it's valuation, funding, the way you negotiate, etc. Because all of these outcomes are about confidence, giving confidence to the investor. The more confidence that investors have in your business and yourself and your leadership and your team, your ability to execute, etc., the more likely you are to then get fundraising on hopefully good valuations, etc. Secondly, understanding valuations. So today we're going to, first of all, speak about the investor psychology, which we've touched on in the other sessions as well, but it's super important. And how investment decisions are very, very rarely made purely on numbers, on spreadsheets, especially with early stage businesses. They analyze people and they analyze the team and what they want to do, and whether that team can take that business on a 10-year journey. Secondly, they will want to understand valuation. Many founders think it's just a simple financial calculation, but in reality, valuation often combines maths with perception and storytelling. And that's why you often see two companies who may look very identical in terms of revenue and product, but receive very, very different valuations, because we'll focus on how investors are looking at what the company could be worth and hopefully will be worth in 5-10 years time, not what it looks like today. Thirdly, we'll talk a little bit around the pitch deck, which it's not just a document. It's your gateway, your anchor for your conversations with your investors. It might be your only conversation at the beginning when there are maybe a few rejections, but that's part of the journey, and we shouldn't let that get in the way of us pushing onwards. A strong deck creates clarity and curiosity, and a weak deck will often create doubt and confusion. Before we carry on, one thing I always like to ask founders is, how would you explain your business to an investor in no more than 1 minute? Could you actually do it? And no, I don't mean 3 minutes or 5 or 15. I mean 1 minute, 60 seconds. And that's super important. They call it an elevator pitch for a reason.
I think that's a powerful point, Daniel, and probably quite a challenge for founders, really, when it's been your life and kind of condense it all into 60 seconds, but a very valuable tool. I think many founders believe fundraising starts with financial projections, but in reality, it starts with trust and confidence. For everyone watching, we'd love to hear your thoughts. Please answer in the chat. If you had just 1 minute with an investor, what would be the first thing you'd tell them about your business? We'll revisit some of your responses during our discussion. And now, Daniel, let's explore why investors reject so many startups before they even reach the meeting stage.
Yeah, thank you very much. We know that very few startups actually receive fundraising, right? 1 to 2%. And that number probably is going down. What's important is about how you communicate and try and get the message across to those investors, and what doesn't really work. People often think it's all about ideas, but it's really not. Because if you're an investor, you hear about great ideas literally multiple times a day. It's often about a combination of execution, selling yourself as founders or founding teams, and being able to iterate a vision of what a company can become. But let's look at some of the reasons why investors will often shy away from investment. So, weak market opportunity. Yes, you may have a great idea. Yes, you might have some customers using it. But is that something that's investable? And investable means that it has to have a high return at some point in the future. Now, remember, VCs are often investing for huge returns. So they're often looking at high millions, hundreds of millions outcomes, or billions. Can your company turn over hundreds of millions or billions in the future? If you're creating a problem that is serving a great market, but you're only ever going to have 100 customers and they're not going to spend that much with you, then that problem or that business maybe isn't investable. So the investors don't look at products. They look at market opportunities and timing. When is the market going to be right for a business such as this? How large can this business become? Poor storytelling. We've already touched on this. And it might surprise people, but actually storytelling is a huge part, because at the beginning stage of your business, the business isn't yet mature. It maybe hasn't got a historic track record and lots of sales and lots of customers. So storytelling becomes super important. And it's about clarity. Can an investor very quickly understand the customer, the problem, your solution, and why now is the right time? If they can't, they'll simply move on. They don't have time to deep dive on something that isn't clear or confusing. They'll just move on to the next opportunity that they have to invest in. Confusion is expensive and clarity always wins. No traction and unrealistic valuation. Again, at what time should you go and speak to investors? I say it's never a bad time to speak to investors in terms of forming those networks, but maybe you're not at the right time to come and ask for a certain type of investment. Founders will often be very bullish. I'm building a company, it's worth X amount of million. The investor will want to know why, and they'll want to know with evidence and with concrete information. Doesn't always mean it has to be with huge sales or huge number of customers, but they'll want to see what revenue there is, what is the path to revenue, what is the path to profitability, paying customers, user growth, any strategic partnerships, retention. Are customers coming back to you over and over? Are you showing the value that you're bringing to the problem? If you've identified the problem, can you prove to us that you're a key part to solving that problem? And every single one of these things, which is what we call traction, minimizes risk. You're ticking boxes in the investor mindset as to why you're less risky than another investment opportunity. And weak founding teams. Very, very difficult because it's very subjective, but they will often invest in people from the get-go. And the reason why that is because markets change, products change, technology evolves. Us consumers and markets move on, but great founders are able to adapt. So they're looking for people that they think, whatever happens in this market, we trust that this team can adapt and find a solution, pivot, etc. And that's why there's lots of these intangibles that they look for in a founding team. And I think that this is why when you have the same startups in similar markets with similar technologies and similar revenues, there's one founder that might spend time talking about product features and what the future could look like, whereas the other founder spends time about the customer problems and really understanding the nitty-gritty of what that market needs and how the market operates. And it's the one that the investor feels is more investment ready that will usually get the more positive feedback from the investors.
That's such an important distinction. It's not just about having a great idea, it's about demonstrating that you understand the business behind the idea and that you can adapt and that you're fluid understanding the full problem. For everyone joining us today, here's a quick question. Which of these do you think founders struggle with the most? Market opportunity, storytelling, valuation, or building traction? Share your answer in the comments. We'd love to hear your perspective. Now, Daniel, we've explored why investors reject opportunities. In the next section, let's look at the opposite side of the equation. If these are the reasons investors say no, what exactly makes them say yes? Let's explore the real drivers behind business valuation. I think you've already helped us understand something incredibly important. Investors don't simply invest because they like an idea. They invest because they believe in the opportunity behind it. Now, naturally, every founder wants to know one thing. How do investors actually decide what my company is worth? Some founders spend months trying to calculate a valuation using formulas and spreadsheets, while others simply pick a number they believe sounds reasonable. Daniel, could you help us understand what really drives startup valuation?
Yeah, absolutely. And this can be tricky at the beginning, right? So if you're finding this process of putting a number on the valuation that you want to come to the market with difficult, you're not the only one. Everyone has similar challenges. And I would always say, do not come to the market necessarily with a fixed number. Almost come with a number that's indicative and have that discussion with the investor. It's in their interest to value you accordingly. Not to minimize your valuation, but actually to value in a way that will help you grow moving forward. But when founders think about investment, they think just about numbers, revenue, profit, EBITDA, financial statements, etc. While those certainly matter, again, if you're an early stage company, you might have less of that information available and certainly less of it historic and repeatable. So they're not looking at what your company's worth today. They're looking at what is the company worth over the next 5 to 10 years. And that's a very different conversation. And that's why you see companies that are operating in similar markets, serving similar customers, etc., but one receives a much higher valuation than another. And it's because the investors value them on very different metrics, and including some of those intangibles. Let's touch on some of these things on what drives valuation. So market size, market opportunity. We spoke about this briefly. The market has to be huge because you're unlikely to command the whole of the market. So so if they want you to be a or a minimum of £1 billion company, and you're not going to command the whole market, that market has to be multi-billion, right? The market might have to be worth 10 billion if you say, well, I'm going to in 10 years own 10% of that market. So that's very important. Perfect example was the Airbnbs of the world and Ubers. Started off with small activations, proving product market fit, proving technology in their local markets. But then the idea was, well, if you can make this work in San Francisco, why wouldn't you be able to make it work across the world? So super scalable, and that's what investors want to look for. Product market fit is essentially showing traction, right? Product market fit is super important for early stage businesses. It's probably the most important, because bringing an idea to market and showing that customers want to buy it and customers love it is really one of the biggest proofs of value and de-risking that an investor can see. It tells the investor the market's already started validating your idea. The strongest pitches rely on assumptions. Don't rely on assumptions. They purely rely on evidence, and product market fit gives that evidence, or traction gives that evidence. Quality team goes without saying. We spoke about this before. Again, early stage, you might not have that many financial metrics. How can you prove or show what the team has done before, what the team has done already within a short period of time, without money potentially, to show that this is a team that's got both the smarts, but also the graft and the hard work and the never say die attitude to make this business succeed. Revenue model, very important. They want you to start thinking about what the business could look like in 5 years. So that's where you might not be making a profit right now, but they really want to see that journey to unit economics and profitability and efficiency. And of course, part of that becomes growth rate. Today, you might have no money, so you're growing organically or via word of mouth. You want to show the investor, actually, if you gave me X amount of money, I know how to turn that lever of growth. So even though it's 10% a month today or 10% every quarter today, I can make it 50% by turning on certain levers and really pushing that scalability. And of course, competitive advantage, which is coming from whether it's technology, whether it's network, whether it's community, etc. What gives you the unfair advantage that other businesses don't have? So super important.
Excellent. I really like that perspective. So valuation isn't just about numbers, it's about confidence. Confidence in the market, confidence in the business model, and perhaps most importantly, confidence in the founders. And that leads perfectly onto our next discussion. If investors evaluate businesses in so many different ways, is there a framework they use to determine whether a valuation is justified? Let's explore that.
Yeah, so these are following on nicely from the others, really. What's going to drive your valuation higher, right? So you don't think about valuation as a starting point that just doesn't move. It's a bit like building a house, right? So you don't start with the roof, you start with the foundations, and that's how you look at the valuation. Businesses are built on strong pillars, and for example, market opportunity is one. You've got to prove that you're in a big enough market that even though you might be a tiny player in now, or maybe not even a player yet, you've identified that the market's big and the market has a problem, and you've got a solution for that market. How can you then show and storytell that in 5 years' time you're going to be a player in that market? You've got to show that. Second one is around that traction and scalability, right? We keep on talking about traction. Early stage, you've got to show in whatever way possible that customers want the product. Customers are maybe joining waiting lists. Customers are engaging with the product and ideally paying for the product, right? That's the first step. And it's sometimes a step before scalability, or it should be before scalability. Getting those first few customers, whether it's pilots, whether it's testers, whether it's just initial users, is really the cornerstone to then showing how you scale. Because at the beginning, you want to show customers purely using the product, touching the product, and getting a benefit from it. You then want to move it into paying customers and scalability. So scaling is super important. Business model is all about strong execution. So yes, you have a business model in terms of how you can grow this business. But again, remember, ideas are very common. Lots of great ideas, as we said. Execution is rare. So investors want to see, can you actually execute? Execution is, again, one of the biggest confidence driver. Because execution, everyone can talk a good game. Everyone can research on ChatGPT. Some people can sell very well. But actually showing execution, showing what you do week on week, month on month, and showing that with numbers is really a huge sign that you are people that deliver, that are not just going to sell me a concept and maybe won't deliver in the future. So they've got to buy into your ability to do work and get stuff done. And another one is around that timing. Some businesses are too early and sometimes they're too late. And the best startups start innovating and evolving when the markets are ready. And again, I'll come back to Uber and Airbnb, those kind of businesses. If they came 5-10 years before, probably would have been way too early. But they came at just the right time when customer behavior and technology had evolved for those ideas to scale and scale globally, just in their own markets. So timing is super important.
It's a fantastic takeaway. I think many founders chase a higher valuation without first building the business fundamentals that actually justify it. For everyone watching, here's a question to think about. If an investor reviewed your business today, which area would be your strongest? Market opportunity, traction, business model, competitive advantage, or founding team? Just take a moment to think about it, or if you're joining us live, share your answers in the comments. Now, Daniel, we've explored what increases valuation. Unfortunately, many founders unknowingly make decisions that reduce investor confidence before the conversation even begins. In the next section, we'll discuss some of the most common mistakes founders make and how to avoid them when preparing for investment. One message is becoming very clear throughout today's session, though. A strong business alone doesn't secure investment. Founders also need to communicate that business effectively. I've often heard founders say, we had an amazing product, but investors just don't seem to understand it. In many cases, the issue isn't the business, it's how the story is presented. And that's where the pitch deck becomes incredibly important. Daniel, what separates a pitch deck that gets ignored from one that actually opens the door to an investor meeting?
Yeah, so before we really touch on the pitch deck specifically, I guess it's what maybe doesn't work in driving confidence with investors. And one of the things that we look for is trying to find a perfect pitch deck or perfect scenario to come to the market with. It doesn't happen. Investors don't expect perfect. In fact, they know perfect is far away. They are trying to build trust and confidence in you, and sometimes that's through the good, the bad, and the ugly. And so that element of perfection, whether it's timing or what you've got to show, is doesn't happen. One of the biggest mistakes I see is pitching without traction. So you've come with an idea, but you haven't got enough meat around the bones about validating the idea, validating that customers want it, having customers even use an MVP. And again, remember, in today's AI world, all these tools that we have are enabling startups to create products much quicker and easier. Think about how we can build a website within hours, build an app within a couple of days. So building MVPs has become a lot quicker and a lot easier. We're seeing customers using products a lot earlier than they used to in the startup journey. So traction is super important. An idea does not get you funding in today's market. And that's really, really important. So investors want evidence that your business is solving a problem. They want to see that the first paying customers are returning, giving you good feedback, maybe recommending you. Maybe you've got some huge testimonials, strong partnerships within the industry, even from those early days. Those are all milestones and indicators that help reduce the risk to the investor. And it's about showing that proof point, even in those early stages. Overpricing is another one. Again, I would say overpricing doesn't often just lead to a no. It leads to a conversation. But if you're going to come into the conversation with a ridiculously high valuation and not have enough evidence to justify it, it really puts you on the back foot. It makes the investor think, not only have you got the valuation completely wrong, but maybe you don't understand the fundamentals of your business, which moves us on to the next one, financial understanding. It's a real big red flag when investors ask questions, and we've seen it on Dragon's Den. They ask a question around your number of customers, returning customers, what's your burn rate, all these kind of things. And the investor doesn't quite know. It makes them worry, because if you don't know the numbers, you don't know your business. And again, we focused on this. We had in the webinar around the financials. Nobody's asking you to be a chartered accountant or a chief financial officer, but you must understand the financial health of your business and some of these key metrics. Investors expect founders to lead with confidence, not uncertainty. Weak unit economics, again, really important. Investors are no longer looking for businesses purely on growth. Growth is great, and if you're not making a profit necessarily today, that's okay. Show them and explain them how those unit economics will improve. Because remember, weak unit economics basically means you're getting more customers, but what they're paying you isn't enough to cover your costs. And unless you can show that changing in 1, 2, or 3 years' time, you're asking someone to invest in a business that's going to lose money. And that's important. It's important to show them that journey. And ignoring the competition. This is a really important one. Sometimes founders think putting competition on my pitch deck is a bad thing to do. But showing the investors that you understand who else is in the market is super important. They might not be direct competitors, right? It might be a slightly different solution, but it's catering to the same end goal for your customers. So it's really understanding who is out there and what you're doing and how you're going to differentiate. And by the way, competition is healthy. If you are coming into a market where there is no competition, maybe that tells the investors there isn't really a problem to solve. If you're the only one solving this problem, maybe there isn't a problem to solve. And actually, no competition might give me a bit of a concern that the market isn't big enough or important enough, or the problem you're solving is not relevant. So that's super important. But above all of these, and usually when investors reject an investment opportunity, it's not one thing, it's a combination of a few. But what all of these things lead to is trust. And it's not about your valuation. Often it's not about your valuation. It's about being able to give confidence to the investor. Every time there is an unanswered question, every unsupported assumption, and any unrealistic claim increases the risk and sometimes loses confidence and trust from the investor. Founders who can demonstrate that they don't know everything, but they have preparation, market understanding, financial awareness, and realistic expectations drive that confidence with the investor. So I wouldn't necessarily come into conversations on how can I increase my valuation. It's more a case of how can I increase the confidence and trust that the investor has in me. Because don't forget, only 1%, give or take, of startups raise money. So don't worry about the valuation. Your first focus should be, let me give them enough confidence and trust that they want to invest in me. The valuation will fall in later on.
Brilliant. Thank you, Daniel. Yeah, it is a valuable reminder that valuation isn't simply determined by the financial metrics. It's built on credibility, preparation, and the confidence that we keep coming back to that founders inspire during every investor interaction. Now that we've explored the common pitfalls that reduce investor confidence, let's move on to another critical element of fundraising, the pitch deck itself. After all, your pitch deck is often the very first impression investors have of your business, and first impressions matter.
So the pitch deck is really your starting point for your storytelling. storytelling is a huge part of fundraising, because often when you're fundraising in early stages, you don't have those critical metrics or 5 years of books to drive the conversation. You're trying to take the investor on a journey of where that business will be in 5-10 years. So storytelling is super important. And the thing with storytelling, we've all been there, right? As an audience, when you've watched a program or watched a film, if that film or program doesn't grab you within the first 5 minutes, you might have completely lost interest. You turn it off. And investors are no different. Pitch decks are part of the storytelling process. And if the first few slides and your storytelling don't create curiosity or clarity, investors will just move on. And because what you're bringing to the market might be quite innovative, it needs to be simple. That's why the 1 minute pitch deck or the 1 minute elevator pitch is so important. You have to be able to explain it within a minute, because otherwise no one's going to give you more. The pitch deck, along with your storytelling, has to drive a journey of where the business wants to go, but also evidence what's happening now when we come to things like the traction. A vision for the future is great, but how can your pitch deck take that investor on that journey? Complex language, lots of diagrams, doesn't work in a pitch deck. The point of the pitch deck and the initial meeting is simply to get you a second meeting. It's not to get fundraising from the get-go. That doesn't happen. We've spoken about fundraising being a several-month process. So remember, the pitch deck and the storytelling is simply to get you to the next meeting. Clear language works. If you can't explain it, or if the investor after the first 15 minutes cannot explain your business back to you, there's a problem. Okay? Some people call it the mother test or your father test. If you told your mum and dad about the business and they couldn't really understand it, maybe you need to simplify it. Simplify how you're explaining it. And always tell the story with momentum. Because at the end of the pitch deck, you want to leave the investors with curiosity, but understanding, almost nodding along to say, yeah, I can buy into this. I may have lots of questions, but I can buy into what you're trying to do. And I'm curious to find out more. I want to know what happens next.
Excellent. Thank you, Daniel. I think that's one of the biggest takeaways from today's session. A successful pitch isn't about speaking more. It's about helping investors understand more. And I guess really giving some credibility to showing that you can walk the walk that you've been talking about for the pitch. We've now explored investor psychology, valuation, and how to communicate your business through a compelling pitch. In the final part of today's webinar, we'll bring together everything with practical fundraising advice, an interactive investor framework, and the key lessons every founder should take away before meeting investors. Stay with us as we move into the final section of today's masterclass. And we have covered a lot of ground today, from understanding investor psychology and startup valuation to creating a compelling pitch deck that communicates confidence rather than just information. Now, I'd like to shift our focus to something every founder asks themselves before fundraising. Am I actually ready to meet investors? Because having a great business and having an investment-ready business are often two very different things. Daniel, before founders begin approaching investors, what should they do to ensure that they're genuinely prepared?
So I think we've covered a lot of the topics that investors look for, and that's where you have to be super prepared. Okay, super prepared. And as you said, investor ready is very different to simply having a business. So it's thinking about, I'm going to go to somebody whose job it is to invest a lot of money in early stage businesses, understanding what they're looking for. If your market isn't big enough, then maybe don't come to the investment decision in the first place, right? So there are certain things you have to be ready. But simplifying it, there is an investor checklist. Number one, can they understand what my business does in 60 seconds? Can I show them my current traction and where that huge scalability and that opportunity of a big market comes to? Yes, can I explain my valuation? But as I said before, that doesn't often kill the deal instantly. So it's being able to explain where I think the valuation could be, but opening it up to their feedback. Defending numbers. right? Whether it's even a handful of users, being able to show how those users have used your product, how they've come back, etc. Being able to defend some of those initial numbers, but also be able to defend why in 2 years' time you think you can get to £1 million or £10 million revenue. Okay, they don't expect it to be accurate, but they want to see that there is a logic and there is a reason for you saying that that's where you're going to take the business. Very importantly, can customers validate your product? Again, that doesn't have to be from users, although ideally it's paying users, but it's about people signing up to guest lists and joining memberships and people having played with the product and actually shown some value. So it's all lots of different ways to show customers are validating your product. And finally, would you invest in your own company? And you've really got to look at this with a clear pair of eyes and very, very objectively, because don't expect people to invest in your company if you don't. And this is just a bit of a short checklist to come to the table with.
Brilliant. Thank you, Daniel. I think this every founder should keep on their desk, not just before fundraising, but throughout their entrepreneurial journey. It reminds us that investment readiness is about much more than preparing a pitch deck. It's about understanding every element of your business, knowing your numbers, listening to your customers, and communicating your vision with confidence. And as we come to the end of today's session, let's reflect on the key lessons we've explored and discuss how founders can continue building businesses that investors truly believe in.
Yeah, so I've had the pleasure of reviewing hundreds of pitch decks, but also creating lots of pitch decks and working with founders on their own pitch decks. And it always surprises me how investors don't reject pitch decks because they're ugly or because they don't have certain buzzwords. They simply reject them if they're difficult to understand. Right? Less is always more when it comes to pitching. You can't tell your whole story in a pitch deck or an initial meeting. Investors are very busy. They have hundreds during every week sometimes of pitch decks. So you don't have the luxury of them taking 30 minutes. In fact, it's very common knowledge that often decks will be looked at for about 2 minutes. So think about that. And that means the first 2 or 3, 4 slides, it's a yes or a no. This is when you're sending them. I'm talking about now, not in the meeting itself. So to get that first meeting, that pitch deck needs to be very simple, very clear, and as I said, be able to convey your customer, problem, solution, scale, etc. very, very quickly. So here we have some examples, right? A bad pitch deck could be very colorful, lots of artistry, but just way too much content and confusing. Whereas a great pitch deck could be simple. Bit of text, punchy numbers, clear funding request. This is very important, actually. Many pitch decks don't even say what it is you're looking for. So you have to finish off with, I'm coming to the market and I want £1 million for my seed round. Small fonts, no storytelling. These are, again, things that make the job of the investor very difficult. So making things super clear, super to the point, metrics, numbers, help storytell, powerful visuals, yes, but don't make them too complicated. And I think these are just very simple ways in which a deck can sometimes start with just how can I, in the most simplistic way, explain my story? And of course, you don't want to make it too long. And I think the next slide is going to talk to that in terms of how we can make the best pitch deck moving forward.
Yeah, I guess it's about keeping yourself in your investor's perspective and just trying to make it as easy as them to pick up and get on board with what you're saying. And that is an excellent reminder that successful fundraising isn't about creating the longest presentation, it's about creating the clearest one that stands out. As founders, it's easy to become emotionally attached to every detail of our business. But investors aren't looking for that. They're looking for clarity, confidence, and evidence. Now that we understand what's effective, let's move on to one final exercise that every founder should complete before stepping into a timeless pitch deck rule or formula.
Yeah, so I think you should always remember less is more when it comes to pitching and pitch decks, and remember how your audience, your investor focus is limited. They are seeing hundreds of these decks. You want to make sure that yours is the easiest and clearest to understand, whilst at the same time as exciting. But this 10, 20, 30 rule is quite timeless, and I really like it. Introduced by a guy called Guy Kawasaki, who's a VC, and it just focuses on pretty simple rules. 10 slides. You shouldn't really have more than 10 slides, and you need to be super cutthroat in cutting that down. As we already said, within 2 minutes, somebody's going to put the deck away. And I include 10 slides, by the way, when it comes to doing the meeting. Stick to the 10 slides to talk around your business, because the best conversations with investors are always two-way. It's an interaction. It's a conversation, almost like a Q&A. So you don't want to have a 20-slide presentation that takes you 30 minutes to deliver. Nobody wants to sit there and be spoken at for 30 minutes. So keep it down to 10 slides. Okay? And that's where it is a real skill and an art and a work in progress to making sure you give not too much information to confuse and create very wordy long documents, but enough to create curiosity, but also clarity. 20 minutes. I actually think the 20 minutes has gone down. maybe when Guy Kawasaki was coming up with this rule, we weren't watching YouTube shorts and these kind of things, but our attention span has gone down. I don't think any investor wants to be spoken to or at for 20 minutes. So I do think there's a way of starting that pitch deck and that meeting in a relatively quicker way. But again, this is where some investors will ask questions during the meeting. Some will let you finish your pitch and then ask questions. Be open to the dialogue. And as soon as the dialogue starts, the meeting becomes richer. So don't prepare to just talk for 20 minutes. It's not necessarily the best way to create simplicity or build that relationship. And finally, the 30-point font. This is like a font size. And I think this was his way of saying, actually, you have to have large font because we don't want to see an essay written on a slide. I think very important here, and this is more of a presentation skill than specific to pitch decks, but you shouldn't be regurgitating what's on the slide when you're presenting. The slide should be your reference point to what you want to talk about. So it's not about reading the words on the slide. That's duplication and kind of pointless. You want to talk around the slide and what's going to really excite and inform the investor. The slide should be a reference point and no more than that. And remember, when you're sending a pitch deck or hopefully delivering the pitch with the deck, your simple aim is to get the next meeting. You're not there to tell the whole business inside out, the next 10-year journey. You're not there to get a yes or a no immediately. In fact, you're there to avoid a no. You won't get a yes in the first meeting, but you'll certainly get a no, as many startup founders have found. And by the way, no's are part of the journey, right? We all know that it takes months, and part of that is because you have to go through tens and tens of meetings where unfortunately you will hear a no before you get to the ones that will hopefully give you a yes. But the first meeting does not get you the yes, but it can get you the no. And remember that.
Yeah, I guess, it's not an easy skill, this. This is, partly why we're doing this session, and to communicate people. Don't be put off by those no's. Use them as learning. And yeah, the key thing that's been kind of running through is that confidence and adaptability, using your slides as a starting point for the discussion and the dialogue that will get things going and get people interested. So yeah, so much. Sometimes we focus so much on creating impressive slides that we forget the real purpose of the presentation. Now, Daniel, after working with founders for more than 2 decades, if you had to evaluate a business before introducing it to investors, what questions would you ask?
What questions would I ask that business? I think first and foremost, I would ask you to invest in yourself, and tell me why. I think I would definitely say, tell me in one line or in 1 minute, what is your business? And if you can't do so confidently, then that would say, well, go back to the drawing table and work on it. I know we spoke about valuation a lot, but I wouldn't focus on valuation. I would ask questions around customers. Who are your customers? Tell me in detail who they are. Have you, how many of them have you spoken to? How many of them are buying from you? This is all about traction, right? This is about them showing me that they know the market, they've engaged with the market, and their belief that they're solving a problem for the market isn't just born from their own hypotheses and research. It's born from speaking to the market. I would ask around, tell me about the size of the market. Show me that it's a big enough market to even warrant this conversation, because it could be the best idea with the best traction from the best team. But if the market's never going to be more than 10 million pounds, maybe, or definitely, it's not worth a VC investor. So I think there's lots of great questions around that. And it is very much around ticking boxes for the investor to drive confidence. And every time you don't tick a box, whether it's around not knowing a question about financials, whether it's around not showing that the market's big enough, you're eroding the confidence levels of the investor, which invariably, inevitably will lead to a no at some point. And that's why it's a real all-rounded approach, I think, when it comes to fundraising. And it's a work in progress. And often, all of the times you hear a no, they will drive you to improve your storytelling, but sometimes your business plan and your product plan, and it'll improve you to the point where you'll hear a yes later on. Let's not forget, many of the biggest companies out there today, often the founders say how they were rejected often hundreds of times before they got the final yes or the first yes. So I think use that as your driving force and your inspiration, that don't give up, because it is a learning curve to raise money in those early days, and every no should be a lesson and a learning tool as to how to get to the next yes.
Yeah, that's really it, isn't it? Being able to take it on the chin and use it as an opportunity for learning rather than, rejection is often a part of the entrepreneurial journey, but as we said, every conversation provides valuable insights that can strengthen the business. And if you have the opportunity to get in front of an investor with a wealth of experience, every second that you're with them, can count towards your own journey. Now, before we conclude today's session, if you could leave our audience, Daniel, with just a few key principles to remember, what would they be?
Yeah, so here's a few that hopefully give us a way forward with confidence. So investors always invest in confidence, not perfection. Perfection doesn't exist. Don't go chasing it. Don't go try and delivering it. And valuation, it's earned, not requested. It's not just a number. You have to try and show them how you got to that number. Even if you haven't got to that number correctly, right? It's not perfect. They want to see there's a thought process. They want to see how you think. Numbers build credibility. So whatever the numbers are, no matter how small, no matter how early, showing numbers shows that you understand metrics, you understand what traction looks like, and you've shown some element of execution. Fundraising starts long before you meet investors. This is super important. If you are at some point going to want to speak to investors and raise money, always think with a hat on. Every business decision should be around, what am I trying to build? And if at some point I'm going to go and raise money, how am I going to make the right decisions towards that investment process? So it's not about just thinking with an investor hat on the month that you've started raising money. It's a constant decision-making and strategic planning towards building a large, scalable, potentially venture-backed business. That's the mindset you should have from day one.
Brilliant. Thank you so much, Daniel, for sharing your experience and practical insights with us today. I'm sure everyone joined has gained a much clearer understanding of how what drives startup valuation and how founders can create stronger, more compelling pitch decks. To everyone who's joined us today, thank you for being part of this session. We hope you found today's discussion valuable and that you will take these insights back into when you're preparing for your next investment round. At the London School of Emerging Technology, we're committed to supporting entrepreneurs through webinars, workshops, startup programs, and industry engagement opportunities designed to help founders build successful, future-ready businesses. We invite you to stay connected with us through our official channels, where we regularly share upcoming webinars, expert sessions, industry insights, and opportunities to engage with our growing innovation community. If you're interested in taking your business to the next level, we also encourage you to Startup Incubator, where founders receive mentorship, practical opportunities, and investment-ready businesses. Before we finish, Daniel, thank you once again for your time, your expertise, and for making today's session both practical and inspiring. And thank you to everyone who's joined us today. I look forward to welcoming you again at our next LSEC. And we wish you every success on your entrepreneurial journey. Have a wonderful day, everyone. Goodbye.